let me introduce the fireside chat on how macro-level developments are moving the industry towards institutionalization. Please give a big hand to our moderator and our speaker. Our moderator for the session will be JD Salbego, who is the CEO at Legion Ventures and also a global blockchain consultant and advisor. Take it away, JD.
Thank you for that wonderful introduction. How are we all doing today? We got a lively crowd, or are you all full from lunch? All right, we got pretty good. I'm a little under the weather, been on the road for almost 6 months straight, so I'm giving you my sultry, sexy voice today, so excuse that. I'm a little under the weather and tired, but just know that I usually charge a lot of money for that kind of voice, and you guys are getting it free today. So I want to introduce Justin Chow, Head Business Development at Cumberland, and why don't you explain a little bit about your background and your company's background, because it's very exciting, and I learned backstage a ton about it, so why don't you go for it?
Great, thanks JD, and thank you for the BlockShow crew for having us. So I run business development for Cumberland out here in Asia. We are a large trading firm, one of the largest OTC trading desks globally as well. We're actually part of a US proprietary trading firm called DRW, which was founded about 26 years ago and today has roughly 900 employees. And so DRW has multiple business lines, and about 5 years ago, they started the crypto asset trading desk called Cumberland to be able to facilitate institutionalized flow and trades in this industry. So today, Cumberland trades about 35 to 40 different crypto assets. Our desk runs 24 hours a day, 7 days a week. We're stationed out of London, Chicago, and Singapore. And yeah, I mean, we trade with some of the biggest funds in the world, miners, ICO companies, et cetera. And so I think the exciting thing for me, coming from traditional finance and moving into this space, is the opportunity to partake in the development of a new asset class and to be able to have high-level conversations with people from the traditional finance world who I can relate to and sort of help educate them in what's happening in this space and why they should be paying closer attention to both blockchain and crypto.
Thanks for that. That was a great explanation. I actually really love this topic. It's not very crazy, wild, and a lot of pizzazz, but it's very nuts and bolts for me. What macro level developments are helping move us forward, institutionalization. Because I think, in all honesty, that is really the goal of this industry, is to move forward into mass adoption and institutionalization. I believe personally, past 6 months, we've seen more macro developments than we have in the past 2 years, maybe 3 or more years, and what I like to believe that is Moore's Law happening in full effect in our industry already, and we're going to start seeing things move very fast. And I think it's an exciting time for all of us, and we should all be really proud that we are the leaders right now in an industry that is literally shaping the future of our world in this moment. And for me, I'm really proud of that, as crazy as this industry is at times, and we all know that. So in 2019, there's been a lot of major developments. I want to talk about one of the ones that was most impactful, I think, to me and a lot of people in the past couple weeks, is that IMF statement from Christine Lagarde, and that is huge. You want to touch on that a little bit and what that means to you and our?
Yeah, I think the trend there of what we've seen in the last 6 months is more reputable institutions and personalities from traditional finance or the monetary system coming out and making comments on the space, and whether or not they they come out in support like Christine has, or they make negative comments, for example, or they point out some of the flaws in the system right now. I think the fact of the matter that the industry is gaining attention is already a sign that there's something going on and people are aware of this. Of the developments here. And so, some of the comments from Ms. Lagarde, as well as, Fidelity's custody solution that they announced recently, or the launch of a couple of regulated exchanges in the United States, are certainly big positive developments that have happened, this year. And so we look at the price of crypto and you might say, oh, we're on the low side. But as a trader, one of the things that I always try to encourage people is that sometimes the price of the underlying asset is not necessarily representative of the development in the space. So an example I like to use is in the stock market, you might say the price of a stock is low, and that may reflect either a lower multiple or might reflect a decline in the future earnings stream of a company. But when it comes to like a commodity or a currency, similarly crypto assets behave the same way. There's no intrinsic value, some may say, and so you look at the price, and it's really oftentimes driven, sounds cliche, by supply and demand. And so what we try to do is we try to separate the price strictly for trading purposes, taking a position and a view, from the developments in the space, which are the high level, both negative and positive macro level news that comes out. And so, yeah, I think with Ms. Lagarde, you've had people like Blythe Masters at Digital Asset Holdings for a while working on DLT solutions in the enterprise space. There certainly could be strong use cases for that. Many of the projects here and around the world that have been presenting have been talking about creating solutions. And then on the crypto side, I think you have, again, like the guys like, the Goldman Sachs investing in BitGo, Fidelity creating their custody solution, et cetera. More reputable names coming into this space that sort of lend a supporting hand to the industry. And so, it's a balance of these two, both positive and negative news flows, which ultimately may affect this industry for the long term.
Very good. Which is why I love moderating this guy, because he knows his stuff. There's many, I think, developments as far as institutions getting involved. I mean, we even have like Walmart, JD.com, Alibaba, B of A, all getting into blockchain, implementing blockchain solutions, acquiring startups that are blockchain, launching their own accelerators as well. I mean, stuff is happening. This is all within the past 6 months. A lot of stuff is happening very quickly. Even in Switzerland, launching the first crypto product. I mean, that's huge as well. So what do you think right now is maybe holding back the industry, or not maybe holding back, or needs to be done and needs to be developed to further institutionalization and mass adoption?
Yeah, I mean, I think to answer that question directly, there are really two things on the radar that need to be solved. And this is an industry where the price and the interest has grown faster than the infrastructure has developed. It's probably the only case in time in history in the capital market this has actually happened. And those two things would be regulation and custody. And so unless you have a solution there, it's very difficult for institutions to come into this space, because they oftentimes have a document called a private placing memorandum, or PPM, and in that PPM, whether it's a hedge fund or long-only fund, it'll state the assets that they're allowed to invest in, and almost always those are regulated assets. And so by design, people say, when are these big funds in the US going to come into this space? Well, they actually can't, because they're not allowed. Right? They're accountable to their investors. They're regulated. People give them money to invest in these specific things, and they're unable to bridge that gap in the moment. And so, if you have a custody solution, you have regulation that solves a lot of the issue. Regulation obviously will allow them to feel more comfortable with best practices being put in place in this industry. That there's a standard that would help mitigate fraud. It may not necessarily eradicate it, but it'll help mitigate it. And then on the custody side, right now in the crypto asset space, some of us have wallets on our phones, or we have our own cold wallets. If we want to send crypto to somebody, if I want to send half a Bitcoin to JD, that's probably too much. If I want to send some fraction of a Bitcoin to JD, at least two or three, okay. depends how this fireside goes. Just kidding. So if you wanted to send it to a friend, you can, and you custody it yourself. But if you again are a regulated fund and you are taking care of your client's assets, it's very difficult for you to trust somebody within your institution, an operations professional, with those keys. And so what a custody does is it provides it reduces the friction for these funds to be able to have security and potentially insurance on the underlying asset being held by them or owned by them, and so that they can feel more assured that if they owned a bunch of Bitcoins on behalf of their clients, that they're still going to be there. And so if you look at even in the traditional securities world, there are custody banks, Bank of New York Mellon, State Street. These are two very large custody banks. If you buy a stock on TD Ameritrade or Interactive Brokers, you don't receive a piece of paper in the mail. You don't own that stock yourself. You don't hold that stock yourself. It's now sitting somewhere, and you're actually paying for that in some way, shape, or form. And so back in the olden days, I can't remember who said this, but someone used a great example that I'm going to repeat here. I can't source it, unfortunately. But back in the day, if you bought a government bond, you would actually receive a piece of paper in the mail, and you would clip the coupon off of it and bring it down to the bank, and you would receive your interest payment. Now that's all electronic, and the bonds, again, the paper might not even be real or created. It's custodied at a bank, and you receive your coupon electronically. And so, in the crypto asset space, until that happens, I think it's going to be difficult for the major institutions to come in. The good news is that there are some developments, some, as mentioned earlier, like Fidelity, lending their brand name of trust and quality to this space. And what that does is it creates the impetus for large institutions to consider the ability now to be able to enter the crypto asset space. And so when you have a reputable name like Fidelity coming in and saying you can custody your crypto with us, what's going to happen is a bunch of these long-only managers or institutional investors are going to call them up and say, I want to learn a little bit more. Maybe I'll retain a headhunter and potentially hire a couple of guys, maybe some of the guys in this room, and you can start working on this project for me and help find out whether or not it's possible for us to actually start managing crypto assets. And so that's the exciting part for me at Cumberland. I've had a lot of these conversations, and so have my colleagues. We've been on the phone both with financial institutions as well as reputable corporations around the world. Some are publicly traded fintech companies. And when we get into these conversations, oftentimes I'm thinking, oh, well, it's just going to be an introduction and tell them that we are a big trading firm, and if you wanted to sell some crypto, you can do it through us. But actually, throughout the conversation, I realized that they have 3, 4, 5, 10-person working teams already. Some of them are very far along in developing their own crypto assets as well. Again, these are companies with tens of millions of users, and many of us in the room have their apps on our phone. And so if they were to create their own crypto, you would just essentially have it on the app on the phone all of a sudden, and you could use it cross-border. And so I think those high-level conversations is definitely what I wanted to share with the audience here. These developments and this sort of natural evolution of the ecosystem from the young entrepreneur with a startup idea into large corporations potentially finding a use case for this technology is happening right now. It's pretty exciting. I don't know if it's mass on scale at this moment. I haven't talked to all the major corporations in the world, but certainly some of these conversations coming in were a bit of a surprise to me. And it's just, again, another sign that the space is maturing, has matured throughout this year. It's been what we call internally a year of building for crypto.
Yeah, no, I totally agree with that. Now, you touched on a lot of great points as far as with the custody and all kind of like the business and regulation side. I think there's still a huge amount of development that needs to be moving forward with on the technology side, because right now we still have these wallet IDs, right? And you can get one letter wrong. Bear in mind, some companies' infrastructures, it's automated, right, with a computer, which will be pretty much 100% or 99.9% accurate, but we still have to copy a wallet ID to different places. And I don't know about you guys, when I'm copying large amounts of money in the 6 figures myself, that's nerve-wracking. I literally copy multiple times, go through it and make sure, like with a fine-tooth pen. To me, that's a major hurdle that we need to overcome for these large institutions to actually be able to serve a customer base that could use that and have a better UX, UI, a better user experience with actually the transactions and stuff. Also, that you send it to the wrong address, it's gone forever. I mean, no bank transferring, $1 billion is going to take that risk, right? We also have a fluctuation in power consumption for mining as well across different territories in the world. So we have no level of standardization with actually what it costs from an output and almost a manufacturing part to create that transaction. So would you like to touch on any of that stuff? Because I believe that's a huge part, too, of us pushing us forward on mass adoption.
Yeah, it's really hard to see how the space is going to evolve going forward. Again, I come from about a decade in the hedge fund industry and managing money. And I look into this space right now, and as mentioned, without the custody solution, it is difficult for large institutions to come in and have wallet managers, as we call them internally. And I'm not one of those guys, but that's a tough job. If your job all day long is sending coins around, it can be stressful. There are some solutions that try to mitigate the risk of wiring coins into space. And BitGo, obviously, is one of those. You can white label some wallets. Full disclosure, at DRW, our parent is an investor in BitGo. I have to say that. But I think also what it'll be is you've already started to see this a little bit in the second half of this year, where you've had paper contracts on crypto being traded. So the CME and the CBOE futures, these are both regulated futures contracts traded in the United States. There's been some rumor that NASDAQ may be launching one too. And so
I just saw that today.
yeah. And so what these are not like the actual physical coins moving on the blockchain being sent around. And so one of the things that I wonder is if it's possible that you could have a hybrid system in the future. And some of you may have heard me say this before, but if you look at the gold market, you can walk down the street in Singapore and you can go to a pawn shop and buy a gold bar, and you can custody it yourself and stick it in a safe in your house. And the transaction spread you'll pay, bid offer, will be absolutely massive. But you own it, you physically touch it, and other than the pawn shop, if they do KYC, probably no one in the world knows that you have a gold bar under your bed in a safe, right? Now you can also go on the New York NYMEX and you can buy gold futures, where the spread is razor thin, the transaction cost is close to zero, and the market is extremely liquid. You can buy massive amounts of gold. You can also buy gold ETFs. I think it's on the S&P. I'm not sure. I think it is. And so what those are derivative contracts, right? Again, regulated instruments. But what they've done was when these instruments were launched, it increased not only the velocity of the underlying, but it also increased the liquidity and reduced transaction costs. And so I wonder, in the future, if we had a major custodian of crypto, if a lot of the actual crypto would just stay at that custody bank, and they would just write paper contracts on top of that. And so you and I in the future, I may be able to send you, a fraction of a Bitcoin. Hopefully it's worth $1 million, I don't know, but I can send you a tiny amount, P2P, friend to friend. But I could also go on there and trade paper contracts of crypto, highly liquid, and with minimal transaction cost and without the risk of coins being lost, because they actually don't move on the blockchain. So I like to call it the hybrid system. I don't know if that's going to happen, but if it were to happen, then you get a whole breadth and universe of new financial assets that could come out of this crypto industry once the underlying asset is custodied. You can have futures, you can have forwards, you can have swaps, you can have options, because once the custody is there, they can control the margin requirements, et cetera, and things will be traded with a central clearinghouse or a prime broker rather than bilaterally right now, which is how we trade OTC, for example.
It's an interesting point, and it kind of reminds me of our convo backstage of things that I'm allowed to say and you're not allowed to say. And so to touch on that, what I heard you just say was you think it potentially could go to a full centralized, almost like a federal reserve, maybe per each country, right? That would have control all the custody, right, of all the coins, and then customers, and somehow that would be dispersed upon private banks, corporate public banks, all through, right? So that'd be a huge centralized system. How do you think that affects, or how do you think that works with the decentralization of this world that we all got into, that a lot of the people who, stand true to this whole utopian power back to the people, which I think is quite funny, and I think it's very great, but a lot of, mass adoption can't happen with that mentality. But how do you think that works? Or how would that work, and how do you see that playing a part in the overall community? Because this is a community, you know what I mean? As much as institutionalization is happening, we are a community of people that are kind of like the renegades pushing this forward, so.
Yeah, I think it's possible for both ecosystems to coexist. And the two examples I'll give are the cash system, where some people may choose to keep quite a bit of cash in their home or in a safety deposit box, where they custody the physical fiat themselves, and then they also have a bank account, and they use credit cards, which are centralized and it's traceable, et cetera. And then again, even in the gold market, in the diamond market, in the commodities market, I think, again, it has that hybrid model where a lot of people in the world, I was watching the show Billions, I don't know if you guys seen it, and they go into his basement and he's got a safe and he's got all these gold bars, right? I think there are people in this world that want physically to hold and own their own stuff, but a lot of them don't want that headache of having to pay the negative carry or the cost of storage or the cost of security to have a bunch of gold bars or diamonds lying around. And so for those people, they will use the custody, they will just buy the future, et cetera. And part of me believes that crypto may have that same ecosystem where it could coexist. You'll have some of the early believers in the space, a bit of the libertarians, who may want to actually own and hold their own crypto. And a lot of these guys are very, very tech savvy, and they'll have their own wallets, and they'll have their own offline solutions to make sure that their private keys are safe. But I think when you look at financial institutions and for them to come into this space, that's a risk they want to outsource, right? That's a liability that they want insured. So the natural path of least resistance there, for me at least logically, is that they'll want some sort of centralized depository where all the crypto is held, and they can just have the title deed and it's a paper transfer after that. So I think it's highly probable. I don't know if it's going to be the way, but it would make sense to me that there's a chance we could have that dual system, and that's kind of exciting. I think it's a win-win for everybody.
Yeah, no, I totally agree with you on that. And oh, a question already. We weren't really there yet, but sure, why not? Let's go for it. Does someone need to give him a mic?
Yes.
Oh, all right.
Just face the top of the cube. Make sure it's close enough to you so that we can hear you.
I like that. You can just throw it, right?
Yeah.
That's awesome.
Hey, oh, I almost gave you a good catch, but
Almost.
good try.
With Fidelity entering the space shortly and New York Stock Exchange, if you will, backed, and this morning Bloomberg announced, as you said, NASDAQ is getting into it, and I'm sure others, other big players entering the space. How do you see these mega stars, if you will, of the financial industry affecting the OTC market and the OTC market players, Genesis, Cumberland, Circle, etc.?
Good question.
Yeah, I think there's always a need for strong liquidity providers, especially ones that are principal traders like ourselves, who are using balance sheet to be able to take positions and be able to provide liquidity out there. Honestly, I think the realistic answer is that what the entrance of these new participants does is it encourages potential new capital inflow. And I'll talk about that. I don't want to paint the picture that it's going to make the market go up, because it might not necessarily be true.
This is not investor advice, by the way.
Yeah, and certainly not allowed to say anything like that. But what it might do, again, it'll encourage people to start researching the ability to have access and exposure to crypto assets. And if they decide that they want to do so, again, these institutions are not retail. They're not going to go and buy $5,000 or $10,000 worth of a coin. It's probable they'll buy tens of millions. And so they will need probably an OTC provider to be able to provide that liquidity to them. And I think what it'll do is it'll just help the market grow in general. And that's kind of what we look forward to. For us in this space, the investment from DRW into crypto assets is not to, participate in the size of the market in its current size. It's to make an investment and help the space grow, help educate people, and share a little how we look at things and how we have our internal processes as a big company. And so as that pie grows, I think you'll need more liquidity providers. So I would anticipate that you'll also see other big firms coming in, not just Cumberland or some other Chicago-based trading firms. It's possible you might actually see banks come in one day as well and provide liquidity. I mean, that's how it works in the FX space. There are prop trading firms who make markets on principle in FX, and then there are major banks that are gigantic market makers as well. So there's a plethora of different types of liquidity providers in traditional markets, and I imagine that in the crypto asset space, now that the friction is being reduced by the entrance of these participants, that'll encourage new players to come in the OTC space as well. So the overall pie is kind of how I see it growing. In terms of specifically regulated exchanges offering liquidity, a lot of people see Backed or ErisX disclosure that's co-founded by DRW, TD Ameritrade. They might say, that's going to allow institutional money to come in as well. But even with the CME and CBOE futures, you can short those contracts also. So it's two-way liquidity. It's not just money coming in, buy on the first news. So you have to assess the situation and decide, who are the participants actually using these instruments at this moment in time. And for the regulated exchanges, even OTC guys like ourselves, we may trade electronically on exchanges and make markets there as well. So there are multiple venues for us to provide liquidity, not just in providing a voice price.
Cool. Do we have any more questions right now? Really? No more. I bet you have another one you have the little box in your hand. You have a follow-up question? You look like it.
I do have a follow-up
I
question.
knew you did. Why don't you go for it?
In my mind, the whole idea of the larger players entering this space is to provide an avenue to purchase large blocks or to sell large blocks of crypto to the institutions. Are you not concerned for the OTC losing that well, I guess I cannot ask a personal question, but are you concerned that the OTC market itself would suffer as a result of the bigger players with potentially bigger liquidity that they can provide to the institutional space?
Well, I think first and foremost, even if you look at some of the regulated exchange or the futures now today, the depth of book has grown dramatically, and you know, I think that they've been a pretty successful launch. But again, I think if you wanted to really move significant amounts of capital, it'd be difficult to do it on these venues and exchanges right now because you would have significant market impact. So the idea is, again, going to an OTC player, if you wanted to do 5,000 Bitcoins, for example, our trading desk would show a live bid and we would just take the whole position from you immediately. And so our job is to transfer that risk to our book and, you know, as professional traders, be able to manage out of that risk through our counterparty base that are asking us for two-way prices all day long, or we may trade it out on exchanges over time, or we may just take a directional view. And so I think in the current state, even while the liquidity on these exchanges has grown, it's still not enough, especially on any one particular exchange, to be able to move real, true institutional size. So that's kind of how I would look at it right there. And the other area I'd kind of draw a parallel from would be the equity market, where, you know, let's say the S&P 500, there's a massive amount of volume going through there. It's very liquid, but yet there are still large block trades of equities going through, and there are block trading desks at major banks around the world, both in the equity space and the commodity space. And so that's a parallel, I think, where the two, again, can coexist. It's just different types of liquidity, depending on people's risk profile. And for guys like us who are a risk-taking firm, we're more than happy to make live prices and absorb people's risk.
Very cool. Good response. You want to throw the little box to this guy? He's got a question. Good catch. All right. You must play T-ball, huh?
First good catch of my life.
Mm-hmm.
You earlier mentioned that there are people now putting contracts on blockchain for digital assets. What are you seeing in terms of people actually developing technologies to move traditional assets, whether it be gold futures, stocks, or more interestingly, specific OTC derivatives contracts onto the blockchain? As last I checked, starting up a typical OTC derivative costs anywhere from about $2 to $35 million, depending on the complexity, the accounting, et cetera. And there's this huge barrier to entry in creating new specialized products. And part of the promise of smart contracts and blockchain was to lower that. Have you seen anybody building platforms that are going to enable this transition from paper to electronic documentation?
Yeah, actually, I've met some interesting projects that are working on exactly that. So for the settlement of, let's say, an option, et cetera, they want it on the blockchain. I think the difficult thing for them there is that a lot of these contracts, they have an expiration date or the settlement date where the contract no longer ceases to exist. So they're not perpetual contracts. It's not like there's infinite amount of Bitcoin that's transferred. It's physical. It's an underlying asset. And so anytime you have an expiration date that, you know, you're going to have to be able to figure out the mechanics of that. I don't have a great answer. I think it's a good question. I still see that the issue with derivatives right now is that there's no prime broker, or there's no central party that is providing the margin requirements and managing the margin. So let's say, for example, if I were to, you know, do an option with JD or to trade a forward with JD, and, you know, it's bilateral, so it's contract, you know, between two parties. I'm going to call him every single day and be like, hey, dude, you know, you got to wire me some money, and, you know, tomorrow I've got to wire you some money. That is highly inefficient, whereas in the traditional finance world, the central party is the one that does all that for you, right? The prime broker, let's say. So I don't know exactly the mechanisms between, or how some of these fellows are going to try to put these derivatives on the blockchain. The other area I would imagine that would be another potential barrier to entry would be the KYC and the AML process, right? I think the whole idea of not really knowing who you're trading with is going to be a hurdle for the industry. And so that's, again, going to be removed if there's a centralized party in between.
Totally. Cool. We got one question back there. That's going to be a far reach. You think you can throw it? Get your football arm out. Nice. All right. We got some good athletics in here.
Yeah. I just want to know, as an OTC, you provide liquidity for the institutional
Could you speak up a little bit?
Can you hear me now? Okay, thank you. I was just saying, as an OTC, you provide liquidity. Now, can you comment a little bit about the futures market? Whether you hedge your position there, and what is your view in the development in that industry? Thank you.
Well, if you look at the full landscape of crypto futures right now, there are unregulated exchanges, crypto exchanges that offer futures, and then there are a few regulated exchanges, the CME, CBOE, and potentially NASDAQ that offer futures as well. They're very different in the sense that, again, I think institutional players will want to trade on a regulated future contract. Then there are some minute details between a cash settled and a physically settled future. I'm not sure if you guys know the difference, but in a physically settled future, if you were to buy the contract as the contract rolls down to expiration, you would get delivery of the actual physical Bitcoin. In a cash settled future, you settle the difference in dollar value. So if I buy, I don't know, Bitcoin at 3,800, and then it expires 20 days later and Bitcoin has gone up, I just make the dollar value difference, and I don't actually have to have a wallet. I don't actually have to touch any crypto. So they're very, very different, and I think we favor a physical settled future because it just reduces the potential for market manipulation or bad behavior. But I think the moral of the story is that, again, the regulated futures coming in are a positive development in the space, and there are probably going to be some more with Bakkt launching their own and ErisX launching some as well. So that seems to be a trend at the moment, I think that trend is just going to be encouraging for new capital potentially to look into the space. But also, at the same time, as I mentioned earlier, it could provide means for people, traditional market participants, to come in and short the space also. And so, as a trading desk at OTC, we try to take advantage of all mediums of liquidity, and we have to assess each medium independently of the risks associated with it. The risk of the exchange, the risk of the financial product, the risk of the structure of the product. I think that's one of the benefits of being part of a big company like DRW. We have a strong risk management team. Of the 900 employees within DRW, about 70 work with Cumberland specifically. That's the risk management team, the legal and compliance team, where we have about 15 professionals. And so they'll help us understand all our exposure there and quantify that exposure in a dollar value as well. So that's one message I'd like to convey as well to the audience.
Thank you.
You cut me off? Or last message. One thing I'd like to convey to the audience as well is make sure you really assess the risk and your exposure in this industry, whether it's market risk or operational risk or regulatory risk.
Thank you so much, Justin and JD. Really insightful sharing.
Thanks, you guys for enjoying this with us.
Big hand.